What if I told you market crashes aren't disasters? They're the biggest wealth building opportunities of your lifetime. While most people panic and sell at rock bottom prices, smart investors know how to turn volatility into serious gains. I've spent the last 7 years helping over 5 million people achieve financial success, and in this video, I'll share 5 powerful strategies that'll help you navigate market crashes like a pro. Let's dive in. When the market drops 20% or more, most investors freak out, staring at their shrinking portfolios in horror. But that reaction is exactly what's holding them back from massive returns. Market crashes trigger our brain's fight or flight response. It makes us want to sell and escape the pain of watching red numbers. But the wealthiest investors, they see crashes as flash sales on great assets. Take Warren Buffett. While millions panicked in 2008, he was buying undervalued companies at bargain prices. History proves that this works. Since 1928, bear markets have lasted an average of 9.5 months, while bull markets run for over 30 months. That's a major advantage if you stay in the game. And check this out. If you had invested $10,000 in an S&P 500 index fund in 1980 and just held on, your money would have grown to over $1 million by 2022, even with multiple crashes in between. Now imagine if you saw the 2008 crisis or the COVID crash not as financial disasters, but as once-in-a-decade buying opportunities. How much better would your portfolio look today? Here's the brutal truth. Most investors fail not because they pick bad stocks, but because they can't control their emotions. When markets crash, our brains react as if we're in actual physical danger. That's why people panic sell at the worst possible moment, locking in losses they could have recovered from. I met an investor who had sold everything at the bottom in 2008. 10 years later, he had 40% less wealth than those who just stayed invested. The difference? Emotional discipline. That's why seasoned investors create a written investment plan, a document that locks in their strategy before emotions take over. Here's what to include: your investment goals and their time horizons, your risk tolerance, and a specific action plan for market drops. It could say something like, if the market falls more than 10%, I'll rebalance my portfolio. This simple document turns panic into a clear, confident plan. Even with a strong mindset, your portfolio needs protection. The key? Strategic diversification. New investors make a massive mistake by betting too much on a single sector. During the 2000 dot-com crash, tech-heavy portfolios lost 80 to 90% of their value. In 2008, financial stocks wiped out portfolios that lacked diversification. The best investors spread their money across multiple uncorrelated asset classes: US stocks, international stocks, bonds, and cash reserves. This way, when one sector crashes, others act like a buffer, keeping your portfolio from completely tanking. Kevin O'Leary says it best: diversification is the only free lunch in investing. Here's a trick that 70% of retail investors never take advantage of: tax loss harvesting. When stocks dip, most people see only losses, but savvy investors use those dips to reduce their tax bill. How? By selling underperforming assets, locking in losses for tax purposes, and then immediately reinvesting in a similar but slightly different asset while the market's still down. So if you've made a bad investment you're still holding on to, market downturns are the perfect time to sell. Here's an example. Sarah harvested $10,000 in losses during the 2020 crash. she was able to offset capital gains of $5,000 and even deduct $3,000 against her ordinary income, saving thousands in taxes. She simply rolled over the unused losses of $2,000 to future tax years, saving her even more in taxes. Just avoid the wash sale rule, which disqualifies your loss if you rebuy the same stock within 30 days. This strategy literally puts money back in your pocket during downturns. You don't need to be a market timing genius to benefit from crashes, you just need to buy consistently. Dollar cost averaging, or DCA, is a simple but powerful strategy where you invest a set amount of money every month, no matter what's happening in the market. Why does this work? When prices drop, your set investment buys more shares at lower prices, and when the market rebounds, those extra shares skyrocket in value. For instance, if you invest $500 a month and stocks are at $50, you'd buy 10 shares. But if stocks crash to $25, that same $500 buys 20 shares, doubling your investment power. When prices recover, you have twice as many shares working for you. DCA removes the stress of when to buy. You're always in the game building wealth automatically. So set up automatic investments and let compounding do its magic. Remember, market crashes don't destroy wealth, they just transfer it. Panic-driven retail investors sell low, while disciplined investors buy those discounted assets and build long-term wealth. But profiting from market crashes is only one part of building wealth. You must also make these 3 game-changing moves to get ahead of 99% of people. Watch the video on your screen.